This company hopes you never file a claim. In fact, their entire business model depends on you paying for years and needing almost nothing in return. Behind every policy sits a team of mathematicians called actuaries. Their entire job is calculating exactly how much risk you represent, down to the decimal point. Insurance only works because most people paying in will never need a major payout. The company is betting on your safety, and statistically, they usually win. Every premium you pay joins a massive shared pool. That pool covers the rare unlucky few, while the surplus from everyone else becomes the company's profit. Notice how premiums rise after major disasters, even in areas that weren't affected. Fear is a powerful sales tool, and companies know exactly how to use it. Marketing leans heavily on worst-case scenarios. The more vividly you imagine disaster, the more willing you become to pay monthly for peace of mind. The real profit often hides in the exclusions section. Dense legal language quietly narrows what's actually covered, long after you've already signed and started paying. When a claim gets denied, it's rarely random. Somewhere in that lengthy contract sits a clause specifically written to protect the company from paying out. Claims adjusters are trained to evaluate every case carefully. Their incentive isn't to make you happy, it's to settle for the lowest amount the contract allows. Industry-wide data consistently shows premiums collected outweigh claims paid. That predictable gap isn't luck, it's the entire foundation the business is built on. Here's the part most people miss. Insurers don't just sit on your premium money, they invest it immediately, earning returns long before any claim is ever paid. That delay between collecting your premium and eventually paying a claim, if one ever happens, gives the company years of investment growth using your own money. This strategy is called the float. Legendary investors have built entire fortunes simply by managing insurance premiums as a massive, low-cost investment fund. Even with a perfect driving record, your premium often creeps upward every renewal. Loyalty rarely gets rewarded the way new customer discounts do. Studies show new customers often get better rates than loyal long-term ones. Companies bet that switching feels like too much effort, so most people simply stay and pay more. Simply calling and asking for a better rate often works. The system relies on inertia, most customers never ask, so the higher price quietly becomes the default. Bundling home and auto insurance feels like a great deal. In reality, it often just locks you deeper into one company, reducing your incentive to shop elsewhere. Health insurance operates on an even larger scale. Premiums rise nearly every year, partly tracking real medical costs, but also partly protecting company profit margins. Behind the scenes, insurers negotiate massive discounts directly with hospitals. Those negotiated rates rarely get passed fully back to you as a lower premium. Strangely, some medical procedures cost less paid directly in cash than they do after running through insurance. The system's complexity often benefits the middleman most of all. Life insurance sold to young healthy people is incredibly profitable. Statistically, the risk of an early payout is extremely low, making early premiums almost pure profit. Most term life policies expire before ever paying out a single dollar. Years of premiums simply vanish into the company's revenue once the term quietly ends. Cancel a policy early, and hidden surrender fees often apply. Even walking away doesn't fully escape the profit built into these long-term financial contracts. Even pet insurance follows the same pattern. Adorable marketing hides detailed exclusion lists that quietly limit exactly what conditions actually qualify for coverage. Travel insurance sold right before a flight preys on last-minute anxiety. Most buyers never read the exclusions closely enough to know what's actually protected. That massive skyscraper downtown isn't funded by claims paid out. It's funded by millions of small premiums collected from people just like you, month after month. After paying claims, covering overhead, and funding advertising, a consistent profit margin remains. That final slice is the entire reason the business exists at all. Slow claims processing isn't always incompetence. Delays can quietly discourage some claimants from following through entirely, especially for smaller disputed amounts. Some policyholders simply abandon smaller claims out of sheer frustration. Every abandoned claim is pure, unclaimed profit quietly added back to the company's bottom line. Insurance is heavily regulated, but the industry also invests significant resources into shaping the very rules meant to govern how it operates. It's a business built on three quiet pillars: collecting more than they pay out, investing the difference, and betting statistically that most customers stay safe. Most people never question that premium line item. It becomes routine, invisible, just another automatic bill quietly funding one of the most profitable industries alive. Insurance sells safety, but profits from probability. The math is quietly stacked so that peace of mind almost always comes at a price higher than the actual risk. Next time you pay that premium, remember, you're not just buying protection. You're funding one of the most quietly profitable business models ever engineered. Subscribe for more.